So when you think about the Australian market, I think it's particularly important to understand the context if you're investing from overseas. And that is a few things. One is Australia is a developed market. It's one of the fastest growing Western markets. It's an economy that is dynamic, and also it's close to Asia. So I think all of those have got really positive attributes. And if you bring it down to what it means for returns, this has been one of the best returning market over many, many years. So it's a combination of those factors. You can buy into a market that's generated strong returns over time. It's a Western market growing quickly, benefiting from Asian growth. And it's a market where there's been a lot of dynamism. One of the other things that's important is that it's a market also with a very rich resource endowment. And we particularly see that in the resource sector. So some of the best mining assets and best mining companies in the world come from Australia. That's obviously very attractive. We've also seen a number of key industries that have been able to go global over time. So think about healthcare, for instance. Australian healthcare as a sector has some of the best companies in their particular niches. If you think about CSL in blood plasma, if you think about Resmed in sleep apnea, Fisher and Paykel in terms of what they do with humidification. So there's a number of interesting companies also that have been able to go global that are Australian listed companies. So I think all of those things make this quite an attractive market. I wouldn't say there are risks. I mean, I think there are always things that you kind of just need to be aware of when you're investing in those particular types of businesses. So firstly, a lot of the earnings tend to come from overseas markets. So that brings an element of foreign currency exposure that you need to be aware of. You also need to have a better understanding of the regulatory environment in those different markets in which those countries operate in, because they can be quite different depending on what country it is. So you really need to understand, for instance, if you think about healthcare, what's happening with US healthcare regulation? What's the objective of the US government when it comes to their healthcare spend? So you need to be on top of all those issues, and that's where I would say that being a global firm, as Rowe Price is, really comes to the advantage of how we can analyse and understand those issues and risks, and make sure that we're taking the appropriate action to be able to maximise return out of investing in those companies. I think when you think about the current rotation that we're seeing, it's obviously driven by an improving economic outlook. We're seeing it domestically, we're seeing it globally. And I think that that's a very valid way to think about how you want to be positioning yourself. But I also think you need to understand the broader context. And the broader context here is that we think interest rates are going to stay low. Now, they might come off the very depressed levels we saw in 2020, but we don't think that they're going to be substantially higher than where they are today. So some people would say that the 10-year bond in the US, for instance, would go to north of 2%. And the reason why we're not in that camp is because if you think about what's going on that's driving a lot of this growth, a lot of it is coming from fiscal spend from governments. And the reason why governments feel comfortable to be spending as much money and running big deficits and seeing big increases in government debt is because interest rates are low. And central banks, and the RBA is doing this, central banks are helping governments finance their fiscal deficits, and that's what's driving a lot of this improvement that people expect. But the reality is they're comfortable because rates are low. So if rates go high, then it's going to put pressure on the willingness and the ability for governments to continue to fund debt and deficit in a way that they are now. So you can see what central banks are trying to do. So the RBA, for instance, this week was aggressively buying government debt to keep interest rates low for that exact reason. So we think that the most likely scenario is that interest rates probably stay around where they are today. So for the Aussie 10-year, it's around about sort of 1.6 to 1.7%. The US is at 1.4 to 1.5. And that's a good kind of interest rate environment to allow governments to continue to spend. But also it's a good environment if you think about what it means for different parts of the market, because that's a good backdrop for growth companies, particularly cyclical growth companies, because the valuation impact of high rates doesn't really impact them with rates at that level, and they will benefit from a strong and improving economy. So we think that the strength we're going to see cyclically in the housing market, and we could see that coming through in strong house prices right now, is going to drive a big improvement in listings for businesses like Domain and REA. So it's those sorts of businesses that we think are going to really participate in the cyclical strength, but also if you kind of look at these businesses over time, these are businesses that generate double-digit revenue and profit growth because of the nature of their business. They are not just cyclical companies, but they're cyclical growth businesses. So it's that sort of company that I think you want to be owning in your portfolio. So a company like Harvey Norman is another example. So if you think about Harvey Norman's business, they sell a lot of furniture product, a lot of cooking product, a lot of home appliances. And again, that part of their business has been pretty subdued now for quite some time. But as the housing market starts to improve, as people buy houses, people move, you're going to see that demand for that part of their business is going to pick up, and it's already started. So, we are looking very closely at what are the companies that can benefit from that strength within the housing market. We think Harvey Norman is very well positioned. And what's interesting about a company like Harvey Norman today is that it actually has a net cash balance sheet. So that gives a business like that a lot of options in terms of how it wants to deploy capital. Does it want to give back to shareholders? Does it want to use it in a way that can further grow the company as well? I think those cyclical growth sectors will be parts of the market that will continue to do well. I'm interested actually in some of the parts of the market that have been left behind. And we're seeing now parts of technology, for instance, are underperforming as the market's rotated out of growth into value and taking a more cyclical view. And I would say that makes sense over a 12 to 18 month period. But if you think about some of these technology businesses, and we're fortunate in the Australian market that we actually have some really high quality technology companies. If you think about Xero, if you think about some of the companies in the buy now, pay later space. So taking a longer term lens, I think there are some good opportunities emerging as the market is leaving those businesses behind. So part of what we're doing is not just thinking about 2021 and how we generate performance and participate in the cyclical growth, but also thinking beyond that and thinking about what are the sort of companies that right now present good opportunities on a 3 to 5 year view. So technology is a sector that I would watch very, very closely, and I think you want to take advantage of some of the oversold opportunities there, particularly in those really strong global franchises. So Xero is one example. So if you think about Xero, Xero is the only cloud accounting or cloud-only software accounting businesses of note. Most of its competitors are kind of this hybrid, right? If you think about Intuit, think about Sage, Intuit in the US, Sage in the UK. Those companies started as desktop businesses and are trying to migrate into a cloud accounting business. Xero just started as a cloud accounting business. And the reason why that's important is that they don't have those legacy issues of having a desktop business, because that really holds you back in the ability to be able to make this transition. Xero is now the number 2 cloud accounting business globally. If you take out the US, you could think about it as being the number 1. And it's a business where it's still the really early stages of its growth profile. It's done a fantastic job in Australia. So it's the market share leader, it's the dominant player. We can see that playing out as well within the UK. And so we think over time, this industry globally is going to be dominated by 2 or 3 players, and Xero is going to be one of those. So that's one of those local tech leaders I think you definitely want to be looking at when it's been oversold because of some of these factors that we've touched on. So from an accounting perspective, cloud accounting adoption in Australia is very high. So it's close to 60% if you think about Australia and New Zealand. Where it's lagging behind is actually in the US, right? So, and part of the reason why that's happening is because, again, there hasn't been this disruptor like a Xero that emerged in the US just to focus on cloud accounting, right? So if you look at industries where penetration tends to be high, it's because some new business model has evolved and it's disrupting the existing competitive dynamic, and that drives penetration and drives growth. You actually haven't had that in a market like the US. So the US is lagging in cloud accounting software. Australia and New Zealand is actually at the forefront, and the UK is somewhere in between. Now, regulation helps also drive some of this. So for instance, we know that the Australian tax office, would like to get all of our information from a tax perspective in a digital format. So that forces companies to migrate to digital. We've seen that in Australia, we've seen that in the UK, but we haven't yet seen that in markets like the US. Look, buy now, pay later is a fascinating space, right? And if you think about Afterpay as a business that originated here, it's now the global leader. And what they've done is to be able to really insert themselves in a really powerful way between a financer and a retail business. So they're owning the consumer relationship, if you want to think about it that way. Why the retailers like this business is because it's a way that when they think about their sales and marketing efforts, they can grow their business. So the choice becomes, do I want to advertise on mainstream media, social media, or do I want to actually form a relationship with a buy now, pay later company like an Afterpay? Because they can help drive sales growth to my business. And so we're seeing buy now, pay later is in Australia a very developed market. It is also in some parts of Europe, but it's really quite new to the US. And so we're seeing Afterpay and Zip, two companies that originated here really at the forefront of this new product that are making big inroads into the US market. So businesses like Klarna and Affirm, they've been around for a while. They're actually not new. Klarna came out of Europe and went into the US. Their model's different. So we're always looking to understand what is the difference in the models, which one we think has got the more powerful economics and powerful product to be able to win and grow market share. So we spend a lot of time analysing that. I would say right now in the buy now, pay later space, the competitive dynamic matters a little bit less today because we're still in the early stages of the category continuing to grow. So on most estimates, buy now, pay later in a market like the US, for instance, is probably a little over 1% of the opportunity. And we think that the total category is going to grow very strongly for a number of years. And in that sort of environment of abundant growth, we think a lot of these business models, at least for the next probably 3 to 5 years, are going to do pretty well. There'll come a time when there's a shakeout, and then it'll be more important around what the specific competitive advantage is of one business. But that's not for right now. So I think we're always looking to understand what those differences are. Right now, in the early stages of the growth and penetration that we're seeing, we think Klarna will do well, we think Afterpay will do well, we think Zip will do well, we think Affirm will do well. But there'll come a time when those things do change. And our current view is that we just think that a business like Afterpay and Zip actually have more levers to pull to be more successful over time.